You may be wondering how mortgage rates are decided. Obviously, you want to make sure that you get the lowest rate possible. But how are mortgage rates determined, and what can you do to make sure you have a low rate? I'm Elyin Perez with Ace Lending Group, and in this video, I will share how mortgage rates work. There are several outside factors that affect how mortgage rates are determined today, but you can control one aspect of your mortgage rate, and that is your own personal factors. Lenders look at qualifying factors to determine your risk level. The better your qualifying factors, the better the interest rate they'll offer you. Mortgage rates begin with the current market rates, so you may wonder how the market affects interest rates. Rates are affected by the overall economy. When the economic outlook is good, rates tend to increase, and rates fall when they're not so great. Mortgage rates are determined by many elements, including the inflation rate, the pace of job creation, and whether the economy is growing or shrinking. When the economy is doing well, borrowers can afford more. The Federal Reserve doesn't set mortgage rates, but it does affect mortgage rates indirectly. The Federal Reserve controls short-term interest rates to control the money supply. When the economy is struggling, as was the case during COVID-19, the Fed lowers rates. These are not the rates given to consumers, but the rates at which banks can borrow money to lend to consumers. When the Fed decides they need to tighten up the money supply, they raise the Fed rate. While this doesn't directly increase mortgage rates, eventually banks and lenders must follow suit to keep up with their costs to borrow money from the Fed. Which personal factors affect your mortgage rate? You certainly cannot control the economic factors of mortgage rates, but you can most definitely control your own personal factors. Let's dive into what you can do to get the best rate possible, beginning with your credit score. A high credit score means you're less of a risk to lenders. A high credit score shows that you pay your bills on time and don't overextend your credit. When lenders pull your credit, they see you as a responsible borrower with a low risk of default. This leads lenders to give you a better interest rate because you are less of a risk. When you have a low score, lenders often change the interest rate significantly because you're at a high risk of a default for the mortgage you're getting. A low credit score indicates that you may not pay your bills on time or that you have overextended yourself. The credit score you need depends on the loan program you're using. If you want a conventional loan, you'll need at least a 620 credit score. But if you choose FHA financing, you'll need a minimum of a 500 credit score. But many lenders out there will have even a higher requirement than this. Taking steps to check and improve your credit will put you in a better position to get a lower rate from your lender. The next factor you can control is your down payment. Lenders want to know that you're invested in the home through a down payment and that you aren't borrowing 100% of the funds. The more money you have invested in the home, the less likely you are to default. If you put down less than 20% on the home, your mortgage rate will increase and you'll need to pay mortgage insurance. There are different types of insurance depending on your loan program. Some can eventually be canceled, but some have to be paid for the life of the loan. Besides the mortgage insurance, if you put down less than 20% on a home, you'll also pay a higher interest rate. When you put less money of your own into the home, you have less incentive to keep paying the mortgage when times get tough. For this reason, you're considered a higher risk, and lenders make up for that risk by charging a higher interest rate. If you have your own money invested though, you're more likely to do what's necessary to make good on the debt. The next factor that impacts your rate is occupancy. Lenders care about whether your home is your primary residence, which means that you will be living there, or if the home is a second home, like a vacation property, or perhaps you're buying an investment property that you'll rent out to others. Rates are usually lowest on primary residences because it's where you're living. You're more likely to make your payments on time because you don't want to lose your own home. If you have a second home or an investment property and have financial issues, you're more likely to default on the mortgage, putting your lender at risk. Most lenders charge higher mortgage rates because of this risk. So what's the bottom line with rates? Well, both market and personal factors affect your mortgage rate. While you can't do anything about the market conditions, you can control your personal factors. Improving your credit score and saving for a larger down payment are two of the best ways to improve your chances of securing the best rate. Be sure to take care of what you can control about mortgage rates by looking closely at your personal factors and ensuring they are as optimal as possible so you get the best rate possible when applying for a mortgage. Always be sure to work with a licensed mortgage professional and get all your questions answered. Thanks for watching. I'm Elyin Perez with Ace Lending Group, and you could contact me with all the details below.